This episode is brought to you by Google Chrome. You think you know a browser, but Gemini and Chrome? That's new. It can help you with practically anything on the web, like restoring a vintage motorcycle from a 50-page restoration blog, or finally break down that long article you've had open for weeks. Gemini and Chrome is here for it. Ready to make anything online make sense? There's no place like Chrome. Check responses, setup required, compatibility and availability varies, 18+.
Trading at Schwab is now powered by Ameritrade, bringing you an expanding library of education with even more ways to sharpen your trading skills. Access new online courses, insightful webcasts, articles, engaging videos, and more, all curated just for traders. Plus, guided learning paths with content designed to fit your unique interests. No sifting to find exactly what you need, so you can spend your time learning to trade brilliantly. Learn more at schwab.com/trading.
Did you know with the Sam's Club app, you're technically in the club, no matter where you are? Like, this is a club. This is also a club. And this is a club. My bad. Come join us. Sam's Club.
Welcome to Markets Radar. My name is Jeremy Quintanilla. This is a show about stocks, bonds, crypto, foreign exchange, private equity, IPOs, and everything in between. And I break it down and tell you what I think it all means. I'm so happy to be here. If you don't know me, I have multiple businesses such as 3T Warrior Academy with Coach JV, Freedom Insurance, Q Financial, Age of Radio, Blockheads, which brings you Merlin, the smartest way to track your crypto. And I am having a fantastic week, even though my allergies are freaking killing me right now. So I do apologize if my breathing is a little bit off because my nose is 1000% stuffed. But I am committed to bringing you what I believe is the most important news in markets, in my opinion, right now. And as you know, some of these companies that I talk about, I invest in. Whenever I invest in a company, I will let you know so that I'm being transparent with all of you. And my number one goal is that you take sovereignty over your own wealth and stop listening to other people. Be a light unto yourself, as the Buddha says, and build your own path, because you know what is going to be the best for your money and what you are trying to do. And that's what we are all here about. Well, that's what I'm here about on the Age of Jeremy podcast feed. Now, right now, Markets Radar is on Age of Jeremy. It will be eventually moving to its own feed. So make sure that you like and subscribe to the Age of Jeremy feed so that you know what's going on with the Markets Radar feed, one. And then two, if you follow me on Age of Jeremy on X and on Instagram, that is where I spend most of my time. And it is a feed all about everything that I have going on. And again, if you're like, why do I want to follow this guy? And the point is because over the last 10 years, I've made myself into a multi-millionaire entrepreneur, and I'm trying to teach other people the things that I've learned and the things that I think that I would have done differently. And I share those things on my Age of Jeremy feed and on my Age of Jeremy podcast. So make sure that you like and subscribe to all that. And also, if you like entertainment, pop culture, and podcasting news, go ahead and subscribe to our Mercury by Age Radio YouTube channel, because that's where I do all the fun entertainment stuff, because I'm a Libra and I love the arts and I love entertaining. But you're not here for that. You're here for markets. So let's go ahead and give a little ka-ching. I don't know if that ka-chinged. Well, let me try it again. Oh, no, that's because the volume's not up. Hold on, I got to bring the volume down or it'll be crazy. We're trying to get more into sound effects here, like a real radio show. Oh my gosh, that ka-ching is crazy. Let's try this ka-ching. Ka-ching, let's get into it. The United States stock market finished the week ending August 14th, 2026 with conflicting signals. On Friday, the S&P 500, which tracks 500 of the largest public companies in the United States, slid 0.2% immediately after closing at a record high on Thursday. I'm recording this on August 15th on Saturday morning for you all. So the news may have changed by the time that you hear it, because again, this is a podcast. Now the Dow Jones Industrial Average, an index of 30 prominent blue chip companies, lost 0.2%, or roughly 180 points, with the technology-focused NASDAQ retreated 0.3%. And just so you know, because I'm going to put it out in the universe, I'm going to have at least 2 NASDAQ 100 companies by the end of the next decade. I'm just putting that out in the world. And then I'm going to retire into the villas in Colorado on my homestead. I don't know why I used the word villas. The entire week, the broader trend remained positive. The S&P 500 ticker, the S&P 500 ticked higher by 0.4%, marking its third consecutive weekly gain. The Nasdaq also managed to post a weekly gain, rising 0.1%. In contrast, the Dow Jones Industrial Average fell 0.6% for the week. This performance matters to our markets audience because investors are currently trying to determine whether the Federal Reserve, the central bank of the United States, will keep interest rates unchanged at its upcoming meeting in September, and I think that it will. It will definitely not decrease it. They might even increase it. I expect an increase by the end of the year. Stocks initially opened higher on Friday because investors interpreted unexpected weakness in consumer spending and sentiment as positive news. Soft consumer data provides further evidence that the Federal Reserve will not raise interest rates at its September meeting, coming immediately after reports of a softer inflation and a cooling labor market where hiring has started to slow down. These figures reinforce expectations that the central bank will stand pat next month. According to data from the CME Group, a major financial services company operating global exchanges, futures traders are pricing in a nearly 70% chance that the Federal Reserve will hold interest rates steady in September, up from 56% a week ago. Futures traders are market participants who buy and sell contracts that bet on the future direction of interest rates. But that morning optimism faded and shares turned lower by mid-morning on Friday. Some investors cautioned that despite the dwindling threat of an immediate rate hike, the continuing Middle East conflict and still elevated oil prices loom large. These geopolitical tensions and high energy costs could stall stock gains in the weeks ahead, especially as the quarterly corporate earnings season comes to an end. Yet, underneath the surface, a remarkable corporate earnings season is keeping this market alive. Some investors believe this bull market, which is a prolonged period of rising stock prices, has further room to run, heavily underpinned by corporate results that have completely defied expectations. According to data from FactSet, a financial data company blending earnings projections with actual reporting results, S&P 500 earnings growth recently stood at about 50% for the second quarter. If that holds, it would mark the highest growth since the second quarter of 2021, indicating corporate America remains highly profitable despite elevated interest rates and a cooling consumer economy. To put this into perspective, let us look at analysis from Mark Heckett, Chief Marketing Strategist at Nationwide. In the words of Mark Heckett, the earnings are about as good as we've ever seen. The breadth of the strength is incredibly wide. Plus, you have this almost built-in buy-the-dip mentality of investors. Hackett added, that's a really good sign for bulls. This buy-the-dip behavior is a strategy where investors immediately buy stocks after a short-term price decline, expecting quick rebounds. And the reason why I feel that a lot of these things, and this is me talking, not Mark, the reason why these things happen now is because we have a better marketplace for retail investors than we've had over the previous 20 years. With things like Robinhood, fractional shares buying, more people that are millennials and maybe older Gen Zs wanting to get into investing and really getting into this market about consumerism and growth and wealth, you get a lot of people that have the mentality of buying more when the prices are low so they can ride it up and then take profits, which is what we teach at the Academy and also what we teach in Merlin, at least the buying the profits. We do believe in not swing trading or day trading on a regular basis. That's just not that there's anything wrong with that. That's just not what we specifically teach for people that are looking for long-term generational wealth. But that's one of the reasons why I think that we haven't seen over these last 4 or 5 years a lot of the pullbacks that we'd had seen in the past, because the market and the way in which people invest has completely changed. Now, this earnings season has not been a free pass. Shares of Applied Materials, a semiconductor equipment maker that designs machinery used to manufacture computer chips, fell 5% despite reporting higher third quarter net income and increased revenue. Even though the company showed growth, it failed to impress investors. This demonstrates that with stock prices near records, companies must exceed the high expectations already priced into their shares. We are also seeing a major shift in the S&P 500 itself. Shares of Reddit surged 13% on Friday following a Thursday announcement by index manager S&P Dow Jones Indices that the social media platform will join the benchmark. So congratulations to Reddit. Reddit replaces Avalon Bay Communities, a real estate investment trust that owns income-producing properties and distributes profits as dividends. Avalon Bay is leaving because it is being acquired by fellow index member Equity Residential. Let us turn to the bond market. Treasury yields, which represent the interest rates the United States government pays to borrow money on the bond market, ticked higher. In particular, the 10-year Treasury yield advanced to 4.695%. This specific bond yield is critical because it directly influences borrowing costs across the entire economy, affecting everything from home mortgages to corporate debt. Now, here is my read on this macro and corporate picture. The market is in a holding pattern because the central bank has reached a delicate policy plateau. We see a clash between a cooling real economy and stubborn inflation risk, while individual stock pickers face high expectations. Reddit replacing Avalon Bay Communities in the S&P 500 represent a symbolic shift, with a traditional real estate trust being replaced by a high growth social platform, highlighting the ongoing index tilt towards digital media, which in my opinion may or may not be a good thing. I'm a little out on whether or not that's good or bad, but as I continue to say, I do feel that we will see a strong pullback by the end of next year in 2027. This tension is perfectly captured by Jay Hatfield, the Chief Executive Officer and Portfolio Manager at Infrastructure Capital Advisors. In the words of Jay Hatfield, rate hikes are off the table. I personally think there's still a rate hike by the end of the year, but he thinks that rate hikes are off the table, but rate cuts are also off the table. We need rate cuts to really fuel the S&P to our target of 9,000. Otherwise, we'll probably stall out in the low 8,000s, which again, I do not believe that we're going to see rate hikes this in September. I do think that we will see them at the end of the year because I think that there's another Fed decision by the end of 2026 in December, and that's when I think that we're going to see that. Now, we can look at the future of these trends through two scenarios. In the first, the consumer spending and inflation continue to cool down without a severe recession, at least this year. I believe that's coming at the end of 2027 into 2028. The Federal Reserve may eventually cut interest rates. I don't think that they'll cut interest rates. I think if they do cut interest rates, it won't be until I want to say the middle of next year, but I'm going to take Kevin Warsh's stand on this and say I'm not going to give any forward guidance on what's going on in that specific space. But again, we do have to keep an eye on inflation and we do have to keep an eye on consumer spending. And that is why I'm always an advocate for middle out economics and not trickle down economics, because trickle down economics seems weird to me. We'll be right back.
This episode is brought to you by Google Chrome. You think you know a browser, but Gemini and Chrome? That's new. It can help you with practically anything on the web, like restoring a vintage motorcycle from a 50-page restoration blog, or finally break down that long article you've had open for weeks. Gemini and Chrome is here for it. Ready to make anything online make sense? There's no place like Chrome. Check responses, setup required, compatibility and availability varies, 18+.
On Friday, August 14, 2026, the Office of the Comptroller of the Currency, which charters and supervises national banks, issued a preliminary conditional approval for World Liberty Financial to establish a national trust bank. Upon final approval, this newly formed entity named World Liberty Trust will operate under a federal charter. This regulatory milestone marks a significant step forward for the flagship cryptocurrency venture of the Trump family, permitting it to officially issue, redeem, and safeguard its stablecoin USD1, which is spoken on air as USD1. To understand this development, we must look at the financial foundation of the digital asset. USD1 is a stablecoin, which is a cryptocurrency designed to maintain a stable value by pegging it to another asset, in this case, the United States dollar. The reserves backing this stablecoin are custodied with BitGo, a digital asset trust company, and the token currently has a market value of about $4 billion. But this conditional approval lands in the middle of a large legislative deadlock. The timing is critical because President Trump's earnings from his meme coin and cryptocurrency ventures, because he's a piece of shit, which I'm not, this is 100% opinion whenever we're talking about Donald Trump here. This is not real journalism when we talk about Donald Trump. I hate that man. I'm just pointing that out. Just in case you were concerned or thought differently, I can't stand him as far as I could probably throw him. And because I am a little overweight and he is overweight, I probably can't throw him very far. But that's that. The bill known as the Clarity Act is designed to establish a comprehensive federal regulatory framework for digital assets. However, the legislation has stalled. The gridlock is driven by deep disagreements over ethics language that would prohibit government officials from profiting off of digital assets. Congress has scheduled a key procedural vote on the Clarity Act for September 15th, 2026. Now, when we think about how does a federally chartered national trust bank actually function if it can't operate like a traditional retail bank? The answer lies in the legal limits of this banking charter. A national trust bank is a specialized financial institution that differs from a commercial bank because it generally cannot accept customer deposits or make loans. Instead of acting as a traditional lender, a trust bank focuses on fiduciary services. For a World Liberty Trust, this means its primary operations will be limited to providing secure cryptocurrency custody, executing stablecoin conversions, and serving institutional clients such as cryptocurrency exchanges, market makers, and investment firms. By securing this charter, the World Liberty Trust gains direct access to the federal financial system without having to comply with the deposit-taking regulations that govern commercial banks. Now, if we trace how we arrived at this moment, President Trump and his two sons, Donald Trump Jr. and Eric Trump, helped launch World Liberty Financial in late 2024. And in all transparency, I do own some WLFI. I bought a little bit to see, once it went on the market, to see if there was any opportunities for profits. And I personally don't have any interest in owning any more of World Liberty Financial or anything associated with Trump. I was doing that from a pure profit standpoint, and I realized that didn't align with my principles because I have no interest in Trump or his family, and I think that they're horrible people. Not only horrible people from people that I know that know them or have done business with them in the past, but just personally, I just have no interest in them whatsoever. But in all transparency, as I said at the beginning of this, I will always let you know when I own something, and I do own World Liberty Financial coin, WLFI. So at its inception, the project was promoted as a decentralized finance project, commonly known as DeFi, which is spoken as DEFI, a term of financial applications built on blockchain networks that aim to bypass traditional intermediaries. Now, the founders originally promised that the project would offer automated borrowing, lending, and trading services. However, those decentralized financial features have still not become available to the public because, again, what I said earlier, the Trumps are useless. Instead, the venture has primarily functioned as a highly lucrative, and just so you know, I will push that until the day that I die, and I will keep pushing it, and you'll be like, I don't want to listen to this anymore, and I will be happy when MAGA is completely out of office. Nothing against the GOP. I mean, it doesn't align with my value systems, and I don't know how it could align with anybody's value systems, but that's a different story. And here we are. Now, instead, the venture has primarily functioned as a highly lucrative commercial enterprise for the president's family. The cryptocurrency empire has generated a large share of the family's recent windfalls. In 2025 alone, President Trump earned more than $500 million in proceeds from selling the project's native digital token, which he called WLFI. On top of that, he earned an additional $263 million in connection with the sale of equity in World Liberty to a select group of private investors. That investor group was led by Sheikh Tahun bin Zayed Al Nahyan, who is prominent United Arab Emirates royalty. And so the preliminary bank charter represents a significant shift in how the federal government interacts with presidential business interests. So the Office of the Comptroller of the Currency is currently led by Jonathan Gould. Under Gould, the regulator has approved several cryptocurrency-focused trust banks, giving digital asset firms broader access to the traditional financial network. That, I think, is great. I think the Office of the Comptroller should do that, and we should do that. But when we do that, those projects and those trust banks should be able to provide a service rather than just creating liquidity for one elite family. World Liberty Financial applied for this trust charter back in January with the goal of institutionalizing its operations. But the integration of presidential business and federal oversight has drawn the strong backlash, specifically from Senator Elizabeth Warren, a Democrat from Massachusetts, released a sharp statement saying, "We have never seen financial conflicts or corruption of this magnitude." I disagree with that. I'm just going to say Nancy Pelosi. To counter this, the White House has previously asserted that neither the president nor his family has ever engaged or will ever engage in conflicts of interest, which is just the dumbest thing I've ever heard in my life. And further, the leadership of this new bank is slightly connected to the president's inner circle. The chief executive officer of World Liberty Financial and chairman of World Liberty Trust Company is Zach Witkoff. Zach Witkoff is the son of Steve Witkoff, who is a close personal friend of the president and currently serves as his Middle East envoy. According to official filings, World Liberty Trust will be governed by a 5-member board alongside Zach Witkoff. The board includes Robert Witkoff, former co-chief investment officer of Chubb Corporation, and Scott Alper, president and chief investment officer of Witkoff Group, Steve Witkoff's real estate firm. The remaining 2 independent seats are occupied by Jeffrey Weiner, former chairman of Markham LLP, and Aaron Baskett, a member of the Financial Industry Regulatory Authority Board of Governors and founder of Sinquanon Capital. We can now see 2 distinct scenarios playing out from here. In the first scenario, if World Liberty Trust successfully meets all regulatory conditions laid out by the Office of the Comptroller of the Currency and passes its final examination, the bank will become fully operational and probably still be useless. Under this scenario, the Trump's family stablecoin USD1 could gain new legitimacy and secure market share among institutional investors, potentially driving its market value far beyond its current $4 billion. That could be a plus for a lot of people that have possibly WLFI, but it wouldn't really change the value of USD1 because of the fact that it's a stablecoin. Now, there's also the second scenario. If the procedural vote on the Clarity Act on September 15th leads to strict ethics amendments being signed into law, the conflict of interest regulations could force the Trump family to divest their holdings, which is what I believe that they should do. Under this alternative scenario, the resulting ownership restructuring could trigger a wave of redemption for USD1, destabilizing its reserve structure and shaking institutional confidence in the newly chartered trust bank before it even begins full operations. You should not have a financial impact, or you should not be able to have a financial impact from being the actual president, apart from the brand that it gives you outside of being the president after you're in your presidency to make money. That part I don't care about. But while you're in there, you have to divest out of all of your stuff and not be a part of any of the operations of those specific businesses. That's just my opinion. And that's the reason why I'm so adamant on Nancy Pelosi and the insider trading that she specifically did, even though it wasn't insider trading. All right, so should you buy WLFI? Like I said, I have some. It's up to you if you have conviction in that and you believe in the things that the Trump family is doing. And I'm kind of judging you for that. But I'm not going to go out of my way to be like, you're a piece of shit because you voted for Trump. I think that he played a huge scam on the American people. And that's just my opinion. And I have no interest in promoting anything that he's doing. But I do want to bring you the news, and that is in the news. And I think that's important because one family is working to kind of control the entire United States infrastructure through right now and then into their MAGA movement. And I don't think that we should allow that. And we shouldn't allow that whether it's the Democrats or the Republicans, because that's not what this country is about.
This episode is brought to you by Google Chrome. You think you know a browser, but Gemini and Chrome? That's new. It can help you with practically anything on the web, like restoring a vintage motorcycle from a 50-page restoration blog, or finally break down that long article you've had open for weeks. Gemini and Chrome is here for it. Ready to make anything online make sense? There's no place like Chrome. Check responses, setup required, compatibility and availability varies, 18+.
All right, let's talk a little bit more about cryptocurrency. Some of this will be rehashed. Some of these things I just said in the last segment, but the federal government's efforts to regulate digital assets hit another major roadblock on Friday as the Securities and Exchange Commission abruptly canceled a highly anticipated meeting to establish tailored rules for the cryptocurrency industry. On Thursday, the Securities and Exchange Commission announced it had canceled its scheduled Friday meeting. At this meeting, the regulatory agency was widely expected to unveil new plans for digital assets. Specifically, they intended to discuss creating a tailored offering regime for certain investment contracts involving cryptocurrency assets. An agency spokesperson stated that the meeting will be rescheduled for a later date due to an unforeseen scheduling conflict. This sudden cancellation is a significant setback for an industry that has been clamoring for regulatory clarity. In fact, if you're in the crypto space, that's all anybody's been talking about. And they've been waiting for the day that the Clarity Act is going to save us all and our fucking cryptocurrency is going to skyrocket. And I feel that people kind of need to pull their heads out of their ass because even if Clarity Act goes through, it's going to take a while for these things to happen. So everybody just be patient. You're like, well, I've been patient. And that's just what I have to go back to. I'll tell people, continue to be patient. This delay comes immediately after lawmakers failed to pass a major cryptocurrency market structure bill, which I just said was called the Clarity Act. This delay was primarily caused by a partisan dispute over the ethics provisions, which I just missed it. So if you weren't paying attention, the provisions would restrict public office holders from participating in the cryptocurrency sector, which is what I believe that they should have to do. A highly sensitive topic after reports revealed that President Dickhead Donald Trump earned $1.4 billion from cryptocurrency and meme coin ventures in 2025. The regulatory stagnation in Washington leads directly into our first question that I have that I want to answer. Why does a canceled regulatory meeting matter so much to the broader digital asset market right now? The answer lies in the ongoing legislative vacuum. Vroom! Without a comprehensive federal framework like the Clarity Act, the digital asset industry is left in a state of suspended animation. Securities and Exchange Commission Chairman Paul Atkins has repeatedly stated that writing clear rules is the top priority for his agency, while urging lawmakers to pass comprehensive market structure legislation. But as long as Congress remains deadlocked over ethics language, the regulatory framework is forced to navigate these complex assets on a case-by-case basis. This leaves both institutional investors and retail participants without the legal guardrails they need to operate confidently, stalling major capital deployments and keeping the industry in a defensive posture as they head towards the autumn midterm elections, which is one of the main things that's going to be utilized in the midterms is the Clarity Act. This lack of regulatory clarity is having real painful consequences for established players in the public markets. We saw a stark example of this late Thursday when Gemini Space Station Incorporated, the digital asset platform led by the Winklevi twins, the billionaire twins Tyler and Cameron Winklevoss, reported its fourth consecutive quarterly loss since going public because, as we have seen from previous things that they were involved with, they have to use other people for their ideas, and then those people steal their ideas, poking at Mark Zuckerberg. And so Gemini went public in September of 2025, immediately before the broader cryptocurrency market tumbled from its record highs, which is probably when you want to go public because you can get the hype of it. In its second quarter earnings report, Gemini posted a net loss of $107.7 million. This represents a loss of 89 cents per share, which was worse than the average estimate of Wall Street analysts surveyed by Bloomberg. Although the company managed to increase its revenue by 37% year over year to better than expected $45.5 million, its overall balance sheet remains under pressure. And again, eventually you have to get to break even at some point, and you can't just keep taking money from people. Or can you? Because that's what people do in this marketplace. Or can't you? The core issue for Gemini is a significant reduction in its scale. The company's total assets dropped 54%, falling to $8.4 billion. Gemini blamed the steep decline on falling digital asset prices and substantial capital outflows from its institutional custody business. In an attempt to diversify its business, Gemini has been trying to move into prediction markets and stock trading, though prediction markets generated just $500,000 in revenue during this quarter. Still, during a conference call on Friday, Gemini president Cameron Winklevoss stated that prediction markets represent the firm's largest near-term growth opportunity because America loves to gamble. He didn't say that, I added that in, because America loves to gamble. That's also why the stock market's probably continuing to do okay. But especially with the upcoming sports season in the second half of the year. And there's a big thing with sports. If you're into sports, I believe Jeff Bezos is working on buying some Premier League team, I think. I don't remember which one. Probably because everybody's high off of football from the World Cup. But sports is a growing medium, and I also believe that the Los Angeles Lakers are being sold to two other people at one of the highest rates in history for a sports team, I believe. But I think that came across on my Instagram feed, so who knows? It could be completely wrong. If established public firms like Gemini are consistently losing money, how can the digital asset industry hope to achieve sustainable long-term growth? The answer is that the industry's survival depends on a fundamental shift away from simple trading speculation and toward real-world utility. Gemini is a relatively small platform in a market where scale increasingly matters. Because it is highly dependent on transaction volumes and digital asset prices, it suffers similar headwinds to those faced by United States market leader Coinbase Global Incorporated. Now, the Winklevoss twins even had to personally invest $100 million of their own money, and I give them mad respect for that when I see them put in their own money, because that means they continue to believe in it, and all the people that I'm around, I wish that they all did that as well. But that's just me and believing in something, and you need to go all in. So I give them props for that. So they put in that $100 million of their own money in May to prop up the loss-making exchange after slashing about a third of their workforces. That shows integrity. This proof of volatility explains why investors are growing weary of pure play crypto platforms. To survive, companies cannot just act as a digital casino. They must build diverse, non-volatile revenue streams, which is exactly why Gemini is racing to build out its prediction and stock trading platforms. And my prediction is that once those prediction markets and stock trading platforms are built out and some of these more of these cryptocurrency companies start to consolidate, my guess is eventually Gemini will be purchased as well. But while established, in fact, if they get to prediction markets and stock trading platforms, and I had that type of money that they're playing with, I would probably buy them for their infrastructure and to get into the brokerage space, right? But that's just me. But while established public giants are struggling to restructure, a new wave of private startups is emerging with a completely different playbook. And that brings us to the New York-based startup called Inversion Labs, which was founded at the beginning of 2025. Instead of buying another exchange or launching a new token, Inversion Labs plans to use a private equity style model to drive adoption. Their strategy is simple yet ambitious. They plan to acquire traditional low-margin companies, overhaul their internal operations by integrating blockchain technology to increase efficiency and reap the resulting profits. The startup recently raised $26.5 million in a seed funding round at a total valuation of $100 million. The funding round was led by the venture firm Dragonfly Capital, with participation from major players like VanEck, Parify Capital, Faction Ventures, and Wintermute Ventures, which we talked about Wintermute, I believe, on Tuesday. The capital from this seed round will be used entirely to fund operations, not acquisitions. To buy companies, Inversion Lab plans to raise a separate fund of at least $500 million under an entity called Inversion Capital. The co-founders, Chief Executive Officer Santiago Raul Santos and Chief Operating Officer Suzanne Danheim, state that institutional investors are showing strong interest because this model offers digital asset exposure with a substantial margin of safety. The innovation model brings us to our last piece in the crypto segment. How can integrating blockchain technology into traditional low-margin businesses actually generate higher profits without exposing investors to volatile coin markets? The answer lies in invisible infrastructure efficiency. As Chief Executive Officer Santiago Raul Santos explained, the goal is to make the underlying technology completely invisible to the end users. Customers will not see how the blockchain works, but they will feel the impact through faster, better, cheaper services, which is the reason why you would use blockchain, because of the way that the technology actually works. For example, Inversion Labs is initially targeting telecommunication companies in South America, where they've already submitted several acquisition bids. By plugging a blockchain-based operating system into these companies, they can significantly lower their data purchasing costs and streamline billing. And my guess is if you can also integrate AI into that, it would also be faster as well. They are also targeting payroll services, supply chain businesses, and consumer finance providers. By replacing slow, paper-heavy, and expensive legacy operating systems with automated cryptographic ledgers, they can rip out deep operational efficiencies. The private equity approach allows institutional investors to gain exposure to the structural benefit of blockchain technology through stable cash flow companies, completely bypassing the wild price swings and regulatory heartaches of holding volatile digital tokens. And the reason why this is important is because this is why blockchain is important. It's not about the coin. It's not about the investing. It's not about that currency piece of it. It's about the cryptography that takes place vis-a-vis the blockchain and general ledger technology, and the speed at which it can do things because of said way that it manages the distributive ledger. And so this is really important because this is going to be the first time, and I'm actually hoping to remember everything that I just read right now about Inversion Labs, because this is a company that I'm hoping.
This episode is brought to you by Google Chrome. You think you know a browser, but Gemini and Chrome? That's new. It can help you with practically anything on the web, like restoring a vintage motorcycle from a 50-page restoration blog, or finally break down that long article you've had open for weeks. Gemini and Chrome is here for it. Ready to make anything online make sense? There's no place like Chrome. Check responses, setup required, compatibility and availability varies, 18+.
To keep my eye on, because this could be super, super beneficial for the future, because of the fact that they're taking the technology and the infrastructure and applying it in other places where, again, you don't have to worry about the volatility of the cryptocurrency specific marketplace, because there's two separate things. There's the marketplace that's generated from the coins that are generated from the cryptography, right, from the blockchain. And then there's the blockchain itself, which is the technology that makes these things much more interesting, and why I get excited about cryptocurrency. I've never been excited about cryptocurrency about making money. I'm fine making $250,000 a year. If you can't live off of $250,000 a year, then your priorities are all fucked up. If you can't live off of $100,000 a year, depending on where you're at, your priorities are probably fucked up. And so my point is, or your values are different. Maybe not that your priorities are fucked up, but your values are different. My benefit of having more money is because I can provide more value in the world by doing more stuff with businesses, doing better businesses with my friends, helping my friends do businesses, and so forth. And so the more of the point of where I guess I was going with this is that the reason why I liked cryptocurrency wasn't because of the money, it was because of the technology. Because eventually, as I always say, the sun's going to burn out and the universe is going to go cold, and that's the end of humanity. And most people are thinking, well, I'm not here right now. But if you look around at how beautiful evolution is, and how beautiful the world is, and how beautiful the life is, I encourage you to change your stance and your mind on that, because the world is a great place, and I want to see it last for millions and millions and billions of years. And it's the things that we do today that are going to impact those things into the future. We'll be right back. We're in a global race for artificial intelligence. It's often measured in raw computing power, private venture capital, and advanced semiconductor chips, which are the highly complex hardware pieces that run modern systems. Yet the ultimate factor shaping how quickly this technology integrates into the real economy may come down to a far more human element, specifically how the public in different nations perceive the technology's impacts on their lives. Because everybody that I know here in Arizona thinks that fucking AI is the worst thing on the fucking planet, which is ridiculous. And since I like saying this, and I've said it multiple times, people need to pull their heads out of their asses. Now, we saw a demonstration of this divide recently at the University of Arizona commencement in May. Former Google Chief Executive Officer Eric Schmidt was booed for praising the benefits of artificial intelligence. So fucking boo me. Meanwhile, Chinese state media celebrated how enthusiastically students embraced artificial intelligence in the classroom. Now, I don't know if this is propaganda or if this is something the state put on because it's China, but let's just assume that this is a true story and that the Chinese kids were super happy. This contract is backed up by data, according to this article. According to Stanford's Artificial Intelligence Index, 84% of Chinese are excited by artificial intelligence, the highest share of any nation. In the United States, the figure plunges to 38%. Similarly, only 32% of Americans trust artificial intelligence compared to 72% in China. And that's because in China, they're one large community that technically is kind of controlled by the state, but believes in their straight state because of the propaganda, but we won't go into that. Now, this gap is not because Chinese consumers completely ignore the risks of technology, nor because Americans avoid using these advanced tools in their daily lives. Instead, it reflects a deep divergence in how citizens in both countries perceive their technological past and their regulatory systems. So why are Chinese citizens far more optimistic about artificial intelligence than Americans? This answer is rooted in recent economic memory and a fundamentally different starting point for technology. For 2 decades, consumer technology in China tracked rising household wealth. For the average Chinese consumer, the smartphone brought mobile payments, online shopping, cheap parcel delivery, and access to the gig economy, which is an online labor market where people perform flexible short-term services, in case you know what gig economy meant. For many in rural areas, this was their first connection to the modern economy. In 2021, the government declared it had eliminated extreme poverty. China eliminated extreme poverty in 2021. Whether directly caused by technology or not, the timing makes them feel linked. In China, technological transformation is remembered as a force that turns scarcity into prosperity, which is technically what technology does, if you use it correctly and you have some fucking discipline on what you're doing. For the average American, the experience has been entirely different. The United States already possessed credit cards, big box retail, and a functional postal service, which I still like post service. The smartphone brought convenience on top of abundance, not a transformation from scarcity to prosperity. On top of that, the defining American technology narratives of the past decade have been largely negative, focusing on social media harming teenagers, the environment because Meta's a piece of shit, the environmental cost of always-on delivery services, and a general erosion of trust, which goes back to your principles and your values, which you need to have for you and your family so that you can make amazing assessments of what you're going to do for the future and how you're going to handle situations in the future and what you're going to do for your family. But Americans, they want to go to sports events and watch football on Sundays rather than going to their church, not saying that people should go to church, but rather than building their religious structure, rather than building their operational structure for their family, rather than building their technology structure for their family. And that's one of the biggest problems in America, in my opinion, and I'll digress. As a result, Americans view technology companies with rising skepticism, and they should because capitalists and corpos and so forth, and associates new developments with job displacement and inequality rather than the upward mobility. Furthermore, we must look at, which is not true because if you look at what technology is happening, the jobs that are being created from technology, it's about a shifting of skills. The problems with most of the Americans and middle and lower to middle class Americans is they don't have a regular conception of always wanting to be learning about new stuff. So they're never upping their skills for the things that change in their industries, for the things that change in what they're trying to do, right? And that's my argument for AI, is that I understand where people are thinking that it's taking away from their art, it's taking away from their jobs, it's taking away from all of these things. That's what technology's always done. It's always done that. Every technology that you are using right fucking now, even listening to this, took jobs away from people, took art away from people, took conceptualization away from people, and those ideas were also probably stolen in some capacity. That's how technology works. The problem is that rather than just fighting against it, right, and saying what can we do better and make it useful with a pragmatic outlook on it, right? They're just, let's go ahead and stop it. It's hurting us. That these people don't need to be billionaires. I am not disagreeing that people probably don't need to be billionaires. And if you are a billionaire, we only need about $7 to $10 billion a year to end hunger in the United States and or the world. I don't know the exact, if it's the US or world. It seems more like it would be the US. And there's a bunch of people hoarding billions and billions of dollars doing that. I'm not saying that that's what should be happening. But what I'm saying is focus on the things that are in your control and move yourself and your family and your life forward. Furthermore, if we look at how workforce exposure plays a critical role in these attitudes, 80% of American workers are in service jobs, which are highly vulnerable to automation. Again, skill set. In contrast, only 46% of Chinese workers are in service jobs, while a fifth of the population is still employed in agricultural labor. Also, because we can't get people to work in agricultural labor in the United States or to grow anything because of work ethic, but we're not going to go into that. This means that the immediate disruptive reach of artificial intelligence affects a much smaller portion of the Chinese workforce. Even when we look at the ultimate goal of building artificial general intelligence, which is artificial intelligence that can surpass human ability in most economically valuable tasks, including writing, coding, and logical analysis, Chinese developers approach it differently. While American leaders warn that artificial intelligence could wipe out jobs, Chinese founders tend to emphasize how it can assist workers, which is what my biggest argument is it can assist you in what you're doing. It will assist you. I'm just going to say that again. Including Tengji of Z.A, Moonshot, and DeepSeek, they emphasize using artificial intelligence to lift productivity and remove tedium from work because, again, they're pushing China as a whole where Americans can't even figure out what the fuck is going on because they have an asshole in office. Then they had an old guy in office who didn't know what the fuck was going on. We haven't had a good president in like 20 years, I feel like, or at least since Obama left. This has led to researchers at the Brookings Institution to describe China as being artificially intelligence pilled, but not artificial general intelligence pilled. There's also a profound difference in how both populations view who holds the leash on those powerful corporations. In the United States, citizens worry that regulators and tech giants share a locker room, which is true because they all blow each other. In China, the power structure is clear. The public has seen career technocrats ground high-flying founders, punish monopolistic platforms, and push tech giants to pour billions into the government's common prosperity campaign. This clear hierarchy gives the Chinese public confidence that the state will ultimately protect them from corporate excesses. Okay. And so again, they have more belief in their state, whether or not there is propaganda that's about that, whether or not China China. So the problem with China, and again, I'm not a scholar on China in any way whatsoever, but the Chinese reward the people that believe in the party and believe in what China's doing. The people that speak out against those types of things, they probably punish because of it being a dictatorship style economy. The difference is that everybody's a communist in China. And with that one communist party, they vote on the people that are going to be running the country. They are able to find policy, right, that can be put into place so they can move policy faster. And at the end of the day, they probably put Chinese people above money and above other people in the world, as they probably should. And if we look at the competitive pressure within Chinese society, often described by the term involution, involution is a term describing competitive treadmill where people work harder just to hold their place. In this highly competitive environment where the pressure is intense, anxiety does not lead to a rejection of technology. Instead, it fuels much faster adoption. Parents rush their children into private artificial intelligence, computer coding courses, and professionals scramble to purchase cheap prompt engineering tutorials. The fear of being left behind is simply much stronger than the fear of change. And again, I feel that that's what always drives me, is I don't like being left behind. And you shouldn't want to be left behind either. You should be okay for change, and you should look as change as a good thing so you can be better, you can make your family better, and you can make your community better. We need to bring things back to community. If you all have a chance out there, please go and read Thomas Mann's Boot and Brooks. It talks about the ability and the benefit of finding a place inside of a community and a family without going too far out of that specific, I guess, geographical area to build wealth and to build fame. When you can do it in smaller pieces that actually will probably provide more benefit to your family and the people around you moving forward. For international investors and technology developers, this cultural divergence is a critical indicator of future market adoption. While American developers face intense public resistance, legal challenges, and demands for incredibly stricter regulatory guardrails, Chinese applications are entering into a highly receptive state-backed consumer market, and this suggests that while Silicon Valley may lead in raw model breakthroughs, China may scale practical commercial artificial intelligence applications at a much, much faster pace, utilizing a highly motivated population that views technology as a proven ladder for prosperity rather than a constant threat to their financial survival. And with that, as I always say, be thankful, grateful, and kind. We'll talk with you soon. Bye. Oh, one more time for fun.